My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do my friends. Just try and make you some money. My job is not just to entertain, but to educate and teach you how it all works. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes the last thing you need in this business is an explanation. There are moments when the action is so darn pointless, so driven by market mechanics, fast ETF trading, algorithms, rather than reality, that real-world explanations will only lead you astray. And that includes days like today, a real good one for the bulls again, where the Dow gained 418 points, S&P climbed 1.23%, NASDAQ jumped 1.33%. It was looking mighty soggy at 10:30. Let me give you some examples. 2 days ago, we had this dramatic decline in the price of oil, down more than 10%. The instant analysis said the oil rally, it was over, done, stick a fork in it. We heard there'd be a slowdown in gasoline because of China's lockdown. We heard higher prices at the pump were reducing demand destruction. We heard Russia was flooding the world with crude to finance its daily atrocities against Ukraine. But the truth was a lot more prosaic. Oil shot up so fast that the actual producers didn't have a chance to get to the oil pits, where you see tons of financial buying and selling. It was just pure market mechanics. Once the oil companies had time to adjust and do some future selling, prices went right back down to $103 a barrel. So there was nothing wrong with the oil rally. The pullback was a reason to buy, not sell, and the bogus explanations, they led you astray. Okay, here's one. Williams-Sonoma. We have him on the show tonight. As this stock plunged from its November highs, the professional money managers constantly were telling me that I should never have had the company on. Why? Because the company was laying people off left and right, so things must be very bad. Then Williams-Sonoma reported last night, and we learned that they were closing a ton of stores simply because so much of their business has gone digital. It's much better. It's more profitable. Turns out there was nothing wrong at all there. The bears just worked too hard to generate a coherent sell thesis. Hey, by the way, another guest tonight, Signet Jewelers, experienced the same kind of bear raid when it rationalized its fleet of stores, saving fortunes for shareholders, boosting gross margins. They were never starved for business. They just didn't need as many physical locations thanks to the robust online presence. Hey, this kind of thing happens every day in tech land. The bears keep telling me that gaming has slowed and that the data center must be woozy, given the, seeming slowdowns at Etsy and Shopify. Never mind that those aren't key accounts. Now, we were told that you had to dump the semiconductor stocks with data center exposure, especially NVIDIA. Oh, boy, was this a classic bear raid. You know what? And I heard this bear raid from everywhere. Everywhere. There was only one animal I didn't hear it from. It's my dog. But as it happens, it's not true. See, earlier this week, we spoke to Matt Murphy. Now, he doesn't work at NVIDIA, but he works at Marvell Tech, which has product in every data center and is partners in a lot of them with NVIDIA. The real story? Can't keep up with demand. So people sold NVIDIA for no reason whatsoever, even as the legendary CEO, Jensen Huang, is about to give his always dazzling keynote at the GPU at the technology conference next week. This is the GTC conference. I've got to tell you, when I heard it last year, well, it was the beginning of the metaverse. Oh, he's going to show you stuff at this conference that is just going to blow your mind. And people sold it because they heard that the data center was slowing. Stay the course, people. Sometimes it's as simple as extrapolation. Earlier this week, we spoke with Darius Adamczyk. He's the CEO from Honeywell, a company with a great deal of aerospace exposure. But it also has exposure to a ton of other brand new end markets, as well as strong selling processed chemicals, refineries, and all sorts of climate control equipment for commercial buildings. Now, that doesn't help the stock. But once this charitable trust holding crosses over to these newer industries, and we stop focusing on aerospace, I bet the stock of Honeywell can go from 192 to 210. There is more to the story than aerospace. How about this one? Eli Lilly, all right? I heard that Eli Lilly's Alzheimer's drug doesn't work, so short the stock. Well, then Lilly develops a novel way to lose weight for type 2 diabetes patients that may be good for everybody, maybe the largest drug they've ever had. Suddenly you have to scramble and buy some before it gets away because something else is happening that's great that's not factored in, and it didn't go the bear's way. So why does this happen so often? Simple. For many portfolio managers, spreading panic is part of the business model. Tons of professional money managers have promised their clients that they'll find stocks that are too high and belong lower. They're committed to finding good short ideas and then knocking them down. That sets up a shadow boxing situation where hedge funds get short, then tell others their thesis, which they actually believe in, by the way. So it's not really market manipulation. They believe in it. And if the idea sounds plausible, the stock goes down, causing other investors to panic because they see it going down. This happens constantly with the semiconductor stocks, and to a lesser extent, the drug stocks. You never seem to know where the next firefight is going to be. So you end up becoming gun-shy about staying long a very good stock. What else drives this action? Right now, this market's got a disease, and it's called multiple compression. Because inflation is rampant and the Fed's hitting the brakes on the economy, Wall Street's willing to pay less for any company's future earnings stream. So the price-to-earnings multiples gets compressed. Now, this is something that's triggered by persistently high inflation, and right now we do have that. The thing about market-wide multiple compression is that it hits the most richly valued stocks the hardest, which is why I've been warning you got to stay away from the high-flying price-to-sales stocks since November. This is why I keep telling you circle the wagons around companies that make real things, sell these things at a profit, then return some of them to shareholders. Now, we've finally gotten comfortable with only buying cheap stocks with low price-earnings multiples. But suddenly this week, the high-flying price-to-sales names are back in style. What the heck happened? Well, let's think back to this. Okay, so in November, when nearly all of these price-to-sales stocks were starting their sickening slide, no matter how much you might have liked your Allbirds or Wheels Up or 23andMe or Nextdoor or Oatly or Rent the Runway, these stocks are getting killed. Then how do they rally now? Well, if you sold them because of inflation worries, like so many professionals did, then wouldn't you want to buy them back now that the Fed's cracking down on inflation? That makes sense to me. It's exactly how a short can become a long, at least for a couple of days. Now, I'm actually describing two different dynamics here. First, we've got the somewhat desperate attempts by hedge funds to find something wrong, then get short, then make a loud public case about why you're right and everyone else should be afraid. The second dynamic is more straightforward. It's just the classic hedge fund playbook that tells you to flee the flimsy and hide in the tried but true going into a rate hike. But the first dynamic is hidden by the obfuscation of money managers who don't want to admit that they're just trying to foment panic. That's against the law. And the second is hidden by the unseen disease, multiple contraction. Many think the answer to this conundrum is to forget stock picking entirely and just go buy an index fund. That was certainly a theme today. I disagree. As I constantly tell CNBC Investing Club members, I think the solution is to stay out of the crosshairs of the young, money-losing stocks, many of which should never have come public and came way too early, and instead just find some solid, tangible companies that make things and do stuff that you like. And then they distribute to shareholders like you generous dividends or buybacks. But the key is to not be taken in by plausible-sounding arguments that turn out to be totally untrue. So here's the bottom line. Many investors are leaving what they believe is a rigged casino, rather than understanding that the market's not a casino at all, just a place where it is, unfortunately, very easy to make mistakes. Even the smartest money manager is going to be wrong a lot of the time. If you're right 60% of the time, you can make a killing in this business. So please, don't take everything you hear as gospel. Jeff, in my home state of New Jersey. Jeff!
Jim, how are you?
I am good, Jeff.
Thanks
how are you?
Thanks for taking my call.
Of course.
I've been following you since the early days of TheStreet.com.
Oh, man, you're dating me to 1996 now. Okay, well, let's go to work.
Yep. Okay. Well, I first want to thank you especially for the chart analysis you give of name technicians, because that gives us some conviction about the near and medium term and enables us to stop trading.
Then I'll do one tomorrow.
Okay.
I'll do one tomorrow because Jeff in New Jersey. I've been debating doing it. Jeff, you're on. What's up?
Okay. So my stock is I'm looking for a disruptor type stock.
Okay.
So that I'll be able to buy near a bottom and hold. They're usually, disruptors for technology or the business model.
Okay. I like this idea. I think it's a good idea. Very sound.
So I've already taken a position in Doma, and I don't know where the bottom of Upstart is, but the one I'm calling about is Bumble. So
I think Bumble has a great concept, okay? The stock is starting to come back because people, this is one that was hurt by inflation. If the Fed cracks down, then it'll do well. I'm going to endorse it, but you got to understand, I don't mean to cop out on this, but it is a long-term idea. It's long-term. Chuck in Hawaii, mahalo, Chuck.
Booyah, Jim.
Booyah.
First time caller.
Okay.
Should we buy Amazon before the stock split or after the stock split?
It won't matter, sir. It's just a leisure amount. It is literally just What will happen is people get stock, and it's more likely actually that some people will sell shares. So it's not a good reason to buy or sell the stock. Let's go to Nathan in Pennsylvania. Nathan.
Hey, Jim, it's Nathan from Pittsburgh. It's been a while since we last spoke, but I want to thank you from this past fall when you did a homework segment on a stock that I stumped you on and you brought on the CEO. That was Element Solutions Incorporated.
Well, thank you, man.
For that.
Thank you.
Hey, this stock that I'm calling in about, it's a great company, great financials, excellent fundamentals, but bad technicals and bad stock price action. The only reason why I'm hanging on to the stock is because I think it has the potential to be bought out. Should I hold or sell Sonos?
Sonos? We shouldn't buy anything for a takeover. However, I've got to tell you, this is a great company. And, I mean, really great. And they've done a terrific job. I've been using Morgan Stanley research on it. I cannot count in selling Sonos. I think it's just too good a company. All right, many investors are leaving what they believe is a rigged casino. But the market's not a casino at all. It just happens to be a place where it's easy to make mistakes. The bears make them all the time. So don't take everything a money manager says as gospel and do your own work. That's what the Charitable Trust Club is about. That's why I started it. On Mad Money tonight, Signet Jewelers, wow, says that weddings will hit a 40-year high this year due to pandemic backlogs. So I'm already married. I guess I get married again. So I might have to after the bacon and everything. So how could this help the jewelry kingpin's bottom line? I'm checking with the CEO. Then there are a handful of stocks that had a nice dividend boost this year, but which of them should you keep your eye on? I'm sharing my favorites. And Williams-Sonoma jumped higher today after earnings, so could the home run performance continue for a stock that I think is dirt cheap? I'm talking the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.